If you put $100,000 into the share market instead of your offset account 10 years ago, you'd have roughly $215,000 sitting in your portfolio today. But if you parked it in your offset account instead and left it there, you might actually be better off. And most Australians have no idea why. This is the question every mortgage holder asks eventually. Offset account or shares? Pay down the debt or build a portfolio? And the frustrating truth is, the internet gives you a clean answer when the real answer is far more complicated. The variables that most people skip over completely are the ones that determine everything. By the end of this video, you'll know exactly how to run this comparison for your own situation, which scenario wins in 2026. And the one factor almost nobody factors in that changes the entire calculation. Let's start with the reality that most Australians are walking into right now. The RBA just raised the cash rate to 4.35% in May 2026. That's the third hike this year. The big banks have already moved their variable rates up. If you're on a typical variable mortgage right now, you're looking at a rate somewhere between 6.2% and 6.8%, depending on your lender. For most borrowers on a $600,000 loan, which is completely normal in Sydney or Melbourne, that rate rise just added roughly $90 to $100 to your monthly repayment, on top of what was already an eye-watering figure. So the pressure is real. You've got money sitting in your offset account and you're wondering, should this be in the market? Or is the guaranteed return of the offset actually the smarter call right now? Here's what makes this comparison genuinely difficult. It isn't just a math problem. It's a math problem wrapped in tax implications, wrapped in psychological risk tolerance, wrapped in market timing uncertainty. And the loudest voices online, the ones yelling invest everything, are often the ones glossing over the parts that actually bite. Most people assume the answer is obvious. Shares return more than the mortgage rate, so always invest. That's the conventional wisdom. And if you've been in any Australian personal finance forum in the last 5 years, you've seen it repeated like gospel. Here's what nobody tells you. That assumption baked itself into a period of interest rates that no longer exists. When the cash rate was sitting at 0.1% back in 2021, your mortgage rate was around 2.3%. At that level, the maths was straightforward. A diversified ASX ETF returning 8 to 10% per year was comfortably clearing that hurdle. There was no contest. The offset account at 2.3% looked like a waste of compounding opportunity. Fast forward to today. Your mortgage rate is closer to 6.5%. Suddenly, every dollar in that offset account is earning you 6.5%, guaranteed, risk-free, tax-free. That changes everything. And I'll explain exactly why the tax-free part matters in a moment. Most people also assume the share market return is simple to compare. Just take the headline number and subtract the mortgage rate. But that's not comparing apples to apples. You're comparing a risk-free after-tax return against a pre-tax, volatile, uncertain one. They are fundamentally different things. The maths only make sense when you strip them back to the same basis. Let's talk about the actual numbers, because this is where it gets interesting. VAS, the Vanguard Australian Shares ETF, has returned 8.35% per annum over the last 5 years to March 2026. Over 3 years, it's returned 9.39% per annum, and over the last 12 months specifically, 11.53%. Those are strong numbers. Across the major Australian share ETFs, VAS, IOZ, A200, SDW, the 5-year returns cluster between 9.7% and 10.1% per annum. That's the real performance data, not the theoretical 10% figure people throw around. Now here's the critical piece. That return is not tax-free. If you're on a $120,000 salary, your marginal tax rate, including the Medicare levy, is 34.5%. That 9.39% 3-year average gets eroded. The dividend from a broad Australian ETF like VAS are partially franked, which helps, but the income component is still taxable in the year you receive it. And if you sell and realize a capital gain, even with a 50% CGT discount after 12 months, you're still handing a portion back to the ATO. On the other side of the ledger, the offset account return is completely tax-free, not capital gains tax-free. Fully entirely tax-free. Because you're not earning income. You're saving an expense. The ATO has no claim on interest you never paid. According to analysis from Passive Investing Australia, if you gross up the after-tax value of an offset return, that is, converted to a pre-tax equivalent so you can compare it fairly to an investment return, a 6.5% offset return is equivalent to roughly 9.9% pre-tax for someone on a 34.5% marginal rate. Let that land for a second. Your offset account, in 2026, is delivering the pre-tax equivalent of nearly 10%, risk-free, with no market exposure, no volatility, no ATO involvement. Now look back at those ETF returns. The 5-year average of VAS is 8.35% per annum. After tax, that's considerably lower. The pre-tax return needs to comfortably beat roughly 10% to win the straight comparison. In recent years, the market has done that, but not always, not reliably, and not without stomach-churning drawdowns along the way. This is not a hypothetical. In 2022, the ASX dropped. Portfolios that were supposed to be beating the offset were instead sitting 15 to 20% underwater, while the offset was quietly, invisibly, delivering its guaranteed return every single day. Here's another number worth knowing. According to APRA data, around 2 million Australian households currently carry mortgage debt above $500,000. For those people, even a modest improvement in how their offset is managed or how the offset versus invest decision is made can mean tens of thousands of dollars over a decade. This isn't a minor financial optimization. This is one of the biggest wealth levers most Australians have, and most people are making it based on gut feeling. So, how do you actually decide? Let's make this practical, because you deserve more than a theory lecture. The first thing to figure out is your effective mortgage rate right now, not the rate on your loan document. The effective rate after accounting for your offset balance. If you've got $80,000 in your offset against a $600,000 loan, you're paying interest on $520,000. Your effective interest cost is already lower than your headline rate. Get that number clear in your head first. Second, calculate your tax equivalent offset return. Take your mortgage rate. Divide it by 1 minus your marginal tax rate. So if your mortgage rate is 6.5% and your marginal rate is 34.5%, the formula is 6.5 divided by 0.655. That gives you 9.9%. That's the return an investment would need to beat, after fees, after tax, to come out ahead of your offset. Third, look honestly at your time horizon. If you need to access this money within 3 to 5 years, whether it's a job change, a baby, a renovation, or an emergency, the share market is genuinely dangerous over that window. BetaShares modeling shows that a 30-year investor who invests in ETFs rather than extra mortgage repayments typically wins by over $85,000 at the end. But that result requires 30 years of patience and a stomach for volatility that most people don't realize they don't have until they are watching a recession wipe 25% off their portfolio. Fourth, and this is important, don't treat this as binary. You don't have to choose completely. A split strategy works. Keep 3 to 6 months of expenses in your offset as a genuine cash buffer. Then debt recycle or invest the surplus above that. Debt recycling specifically is a strategy worth understanding. It's where you convert non-deductible home loan debt into deductible investment debt, effectively making your mortgage tax deductible over time. It's legal, it's effective, and it's completely underutilized by ordinary Australians. If you're investing, platforms like Perla are built specifically for long-term Australian investors. Automatic investing, low fees, no distractions. On Perla, you can set up a regular VS or A200 buy without logging in every week and making emotional decisions. That friction removal matters more than most people realize. ComSec and self-wealth work too, but Perla is designed around a long-term passive investor mindset. Fifth, consider super. The concessional contribution cap for 2026 is $30,000. Salary sacrificing into super and investing in a growth or high growth option inside Australian Super Australian Retirement Trust is taxed at only 15% on the way in. That's a guaranteed tax saving before a single investment return has been made. For most Australians on an average or above average income, the super contribution is often the highest return action available, and yet it's the one people overlook because the money feels locked away. Here's what inaction actually costs you, and I want to put a number on this, because the abstract version never lands. Imagine two Australians. Both have a $600,000 mortgage at 6.5%. Both have $100,000 sitting outside their loan. One puts it in the offset. One invested in a diversified ETF portfolio and owns 9% per annum. Over 10 years, the investor ends up with approximately $236,000 before tax. The offset account person has saved approximately $65,000 in interest, effectively guaranteed, tax-free, after tax, and this is a part that shifts the comparison. The investor's actual net benefit narrows considerably, especially in the early years when the market might be flat or negative. But here's the version nobody talks about. The Australian who does nothing, who leaves at $100,000 in a basic savings account earning 4.5%, loses over $20,000 compared to the offset option alone. Not compared to investing, just compared to the passive, do-nothing choice of parking it in the offset. $20,000, quietly vanishing into a savings account that they thought was safe. The worst financial decisions aren't usually dramatic. They're the slow bleeds. The money sitting in the wrong place, month after month, year after year, not because you made a bad decision, but because you made no decision at all. In 2026, with a mortgage rate at 6.5% and a market returning historically around 9 to 10% before tax, the gap between the two strategies is real, but it's much closer than the internet wants you to believe. And for a large chunk of Australians, particularly those with shorter horizons, higher tax rates, or lower risk tolerance, the offset is not the boring, conservative option. It might genuinely be the optimal one. Before we go, if you haven't subscribed yet, hit subscribe now so you never miss when we break down something the average Australian isn't being told about their money. And drop your answer in the comments. Right now, with rates at 6.5%, would you put $100,000 into your offset or the share market? And why? I read everyone.